Welcome to this economic policy webinar. My name is Kevin Mumford. I'm the COSICH Director of PURCE, the Purdue University Research Center in Economics. Just to give a brief introduction to the center, the center's mission is producing and sharing empirical economic policy research. Our researchers analyze data to better understand how laws, regulations, and government programs affect our lives. And then we communicate our research findings to government, business, and community leaders, as well as to the general public. This webinar today is part of that communication effort. In addition, we write op-eds, policy briefs, press releases, and then we also make our faculty affiliates available for media interviews. We host a series of information sessions on policy topics for government leaders at the State House in Indianapolis. And just in general, try to disseminate this information. The Research Center in Economics was founded on a belief that incentives matter and that government interventions often have unintended consequences. But what unites us as a group of scholars is the belief in the power of data analysis. We're not a think tank with a particular policy agenda, and we do not speak with one voice. Each individual researcher follows the data towards those conclusions that are supported by the evidence. So now I get to introduce our speaker today. Our speaker is Professor Jonathan Black. He joined Purdue after earning his PhD in accounting from the University of Colorado in 2015. And at Krannert, he teaches doctoral seminars in accounting research, and also the first course in the undergraduate financial accounting sequence for accounting majors. The course sequence prepares our students, our undergraduate students, for the Certified Public Accountant exam, and Dr. Black himself is a CPA. He has a large number of research papers, and looking through them, I think the important common theme is the importance of information, and his work really highlights the value of disclosing information to the public. So today's webinar is certainly related to that. The topic is accounting fraud and how it is uncovered. So after Dr. Black's presentation, we will have a Q&A session, and I encourage you throughout the presentation to be typing in your questions into the chat feature, and then I'll ask them at the end so that Dr. Black has a chance to respond. So with that, Dr. Black, please go ahead.
Thank you, Kevin. I appreciate this opportunity to talk a little bit about our fraud and my research. It's an interesting area. A lot of people are exposed to it. When something really bad happens, it ends up all over the news. So, I used to be an auditor, so I think this is an interesting area to kind of research. Just a little bit about me. I started my accounting career. I used to work at KPMG. I started there just after the Enron and the 2000 tech collapse, and then kind of went into academia right after the financial crisis. So exposed to a lot of fraud, a lot of things like this, and so it got me interested in it. So I guess the theme of today is to talk about how auditors are equipped to uncover fraud and how might auditor disclosure help. And just to start off, I just want to talk about what we're, identify the characters here. So financial fraud is financial statement fraud is what we're talking about. That's a situation where management knowingly reports incorrect or misleading financial accounting information. And so the key is intent here. I think that's really important. Audits may be able to catch lots of misstatements and errors, but when it's an intentional fraud, I think this is going to be a theme I talk about, it's harder to catch. And so, what we're talking about is revealing fraud after it's already begun. That's another point I'd like to make. There's other deterrents incentives that might be in place about committing fraud in the first place. I'm not necessarily talking about that. I'm talking about actually revealing once it's out there. And then finally, the auditor that I'm talking about is the external auditor. Another character that might be involved is an internal auditor, someone who audits on the part of management. But I'm talking about the external auditor. This is the auditor that's hired to review the financial statements filed at the SEC by public companies. It's a third party that comes in. So if you heard of the big four accounting firms, that's what they mainly do. One of their main businesses is auditing public companies. All right, so there's sort of an expectations gap about what these external auditors are supposed to do and what they actually can do. There's a long-held belief that auditors are a public watchdog, meaning that they protect against all fraud at public companies in their financial accounting, financial reporting. Even Arthur Levitt, who is a former SEC chairman, he said that auditors, the mission described in the Securities Act of 33 and 34, the acts that established auditing as required. The mission of that was to protect the public investor from financial fraud. So there's this perception that these auditors are there and their main goal is to protect against financial accounting fraud. But research has shown, the 2010 paper in the Journal of Finance shows that auditors only blow the whistle on about 10% of frauds. So they're not doing the majority of the fraud catching. This number's gotten a little better since SOX instituted some procedures where auditors have to think more about fraud, SAS 99. But that number is still about 25%. So it's not, they're not the number one catchers of fraud, or the number one of people who bring it to publicly reveal fraud. So there's an expectation gap. What can auditors actually do, and what's the expectation of them? The expectation is to catch everything, right? The focus of the audit is really just to provide a reasonable assurance that the financial statements are prepared fairly and in accordance with GAAP. It's not a guarantee that the financial statements are accurately presented or are without fraud. Even the standard that came out after Enron, SAS 99, says that even a properly planned and performed audit may not be able to detect all fraud. So, why is that? Why we have to talk about what the financial statement audit looks like. A financial statement audit isn't going to test each and every account. They're constrained by costs. Auditors can't, with a big multinational company, you can't test every account, you can't test every transaction. So instead of that, a financial statement audit uses sampling and testing based on the materiality of each account, meaning whether or not that account is going to affect an investor or an creditor's decision making. So based on these materiality judgments and on the sampling, they pick accounts to look at and they test these accounts. Testing every account would be incredibly costly. One estimate was 70 times as expensive as a current audit. This model is not going to be perfect in catching fraud every time. The standard that came out after Sarbanes-Oxley and Enron, SAS 99, requires auditors to at least brainstorm and think about areas where fraud might generate material misstatements, but still, they can only test a certain amount of accounts and a certain amount of transactions. So, what might occur that would allow an auditor, what might happen where an auditor might miss a fraud? Well, there's voluminous accounting records. You need to do sampling, right? Some accounts aren't going to be tested. If the accounts that are fraudulent aren't being tested, you're not going to catch the fraud. Auditing techniques cannot really identify fraud if a fraudster uses outsiders to conceal it. So, a lot of the techniques that auditors use, sending confirmations, if you think about auditing a cash account. So a company might tell you that they have $10 million at JP Morgan. And you send a confirmation to JP Morgan and they sign it and say they have $10 million. Well, if there's collusion between the company and JP Morgan, I don't know how you're going to figure out, the procedures that they're doing aren't catching this collusion. As an auditor, it's really tough to deal with collusion. Another situation could occur where you have a materiality judgment. You're going to look at accounts that are material. Well, if the fraudster knows that what your materiality level is, they can hide their fraud in all these non-material accounts. And it's really hard when there's an intentional misstatement of financial reporting going on. and you have collusion going on. There could be forgery, there could be lying. These things auditors aren't equipped to deal with. And finally, there's just a reluctance if your boss tells you, if you're auditing a company and the boss tells you to do something, there's a reluctance of employees to talk badly about their boss, to disclose what they know about the company. So these things could all lead to auditors missing fraud. And the legal system doesn't necessarily force auditors to force a penalty on auditors if they miss a fraud. What the legal system requires is due care from auditors. And a lack of due care might be inadequate training or experience, poor audit execution. So if there's bad planning, gathering evidence, or examining controls, or if there's a failure to exercise, failure or lack of independence, these things can get the auditor in trouble. That's really the extent of what gets an auditor in trouble. So there could be frauds that an auditor misses, and they might not pay a penalty for it. The other thing to think about with auditors is really their incentives to catch fraud. They're not necessarily incentivized to catch fraud or to perform the task of a gatekeeper or a fraud catcher. Certainly they don't want fraud to happen at their companies, and they want to resolve it. And I think they do lots of procedures to do that. But since they can't catch every fraud, they have a sort of unique position here. With regard to kind of two things that really motivate auditors to do their job are litigation risk, which is going to have, if they get sued, they have to pay out money, right? And also their reputation. So I'll talk about how litigation and reputation, on the face, they should influence auditors to catch fraud or to be proactive in finding fraud, but not necessarily, right? So with litigation, auditors, could get sued for not catching fraud. However, auditors are kind of disincentivized of providing additional audit procedures to catch fraud by looking more into whether or not a company has committed fraud. They may actually find something that looks like fraud, document it, but decide that it's not actually fraud. And then later on, it comes out that it's fraud, right? So there's sort of and if that happens, they get to a court of law, the jury looks at the auditor and they say, well, you looked into this area, you knew about it, you were complicit in it, right? You're a responsible party here. And since auditors can't really guarantee fraud detection, and there's judgment that goes on here, they don't necessarily want to look into it as much, right? The more they look into it, the more they might be legally liable. There's this argument here. The other thing is about reputation. So if you might say auditors, they should catch fraud because if they don't catch it, they'll get a bad reputation and nobody's going to use them again. Well, that's not necessarily true. What's true is if you audit a fraudulent company, it's definitely harmful for your reputation as an auditor. There's a paper at the Journal of Finance that says, when companies when auditors reveal fraud, they don't necessarily get any benefit from it. They actually don't gain extra customers. The reputational benefits of revealing fraud doesn't really do anything for auditors. So there's not a significant benefit to revealing the fraud for the auditor, but they do actually lose their job. So the thing about, if you disclose that you think your client has committed fraud, 50% of auditors that blow the whistle on fraud are fired, according to this paper. And so and part of the reason is because auditors are hired either by management before SOX, and now they're hired by an audit committee, which is associated with the company. So, the auditor doesn't have necessarily a great incentive to reveal fraud, and they have a disincentive, right? Because they're probably going to lose the client. And that can be a big deal, right? If you're a small audit office, and this client is a large source of business for that audit office. So what's really the solution? So we can't really trust an auditor to catch fraud. It's probably too costly for them to perform an audit that was going to guarantee against fraud, and they're not perfectly incentivized to perform procedures that actually catch fraud. However, there's other probably better incentivized parties out there, like short sellers. So if you know short sellers, they make money on picking stocks that are going down in value. They have a great incentive to find fraud, because if they find a fraudulent firm, a firm that's committing fraud, they short it and they make a ton of money. So they're very well incentivized to catch fraud. The media has a great incentive to catch fraud. You know, viewers want to watch stories about fraud. And actually, you know, they find that recent research shows that 14% of frauds are found by short sellers, 13% of frauds are found by media. So that's a higher percentage than auditors. So, the thing that in my paper we look at is auditor disclosure. So, auditor disclosure is the information that auditors bring to light might be valuable for these other better incentivized parties. So, what we look at is how auditor information affects the duration of fraud. So, if you look at how long a fraud lasts, the assumption is that maybe when information about the fraud gets to a tipping point, somebody out there is going to blow the whistle and stop the fraud. Auditors send signals through their audit opinion, through their auditor switches. If they quit, they don't want to work on an audit anymore, they leave the audit. That's an effective signal. If they put something in the audit opinion, we think that that's valuable for ending a fraud more quickly. So even if auditors are not perfectly incentivized to blow the whistle, if they provide some information to these better incentivized parties, they might actually do that. So one thing to think about is, what do auditors actually disclose? Well, they disclose an opinion, basically a piece of paper that says we think that these financial statements are prepared fairly and in accordance with US GAAP. That's an unqualified opinion, and the majority of these fraudulent financial reports get unqualified opinions. Those opinions can actually be adjusted with explanatory paragraphs. So one of the things we look at in the paper is whether these explanatory paragraphs, which really highlight just kind of changes in accounting standards or departures from normal audit procedure. So nothing really that they're sort of innocuous things, right? But they appear there, and the fact that one company is getting some kind of additional explanatory paragraph while another company doesn't suggests that maybe the auditor is providing some hidden signals to people about something fishy going on here. So we actually find evidence that frauds are more likely to be revealed after the fourth quarter financial statements are released with explanatory paragraphs. And fraud-related misstatements are 2 times more likely to end following an audit report with the explanatory language. So that's kind of interesting to us. We think this is an informative signal that's being sent through the audit report by auditors. And so even though they're not blowing the whistle on more than 10% of frauds, at least they're providing some information. So they're playing another role in the cessation of fraud. And I think this is particularly important today because the PCAOB in 2019 started requiring required auditors to disclose even more information in their audit reports. Now, auditors have to provide a discussion of critical audit matters, which are kind of a couple paragraphs that highlight material areas of judgment, and difficult or sensitive issues that came up in the audit. And so, this is very recent research, or very recent requirement. And so the results from my paper seem to suggest that the addition of CAMs to the audit report could induce even quicker revelation of fraud. I think it's an important change that the PCAOB has made to require auditors to provide some additional discussion about the audit. I think it's great that auditors are actually disclosing a little more about themselves and about the audit, and I think it really could have an effect on fraud, but it's a little too early to tell with CAM's disclosure. But like I said, this is probably, the disclosure we look at in our paper is even more innocuous than this CAM's disclosure. So I think this CAM disclosure is really going to do something for fraud revelation, and I think I hope a lot of it is sort of boilerplate, which has been a criticism of CAM's disclosure. It's all the same, but if you look at one company that gets a CAM in a certain area and their competitor doesn't, you're going to learn something about that company that got the CAM disclosure. So I guess that's I don't want to ramble on too long here, but I guess kind of the point of this talk was to provide some evidence. Provide evidence that the auditors kind of face a gap between public expectations of them as fraud watchdogs and their actual ability to catch fraud. And it's not really the auditor's job to guarantee that the financial statements are entirely free from fraud. If they were to do that, it would be incredibly costly, and it'd also be very difficult for auditors. Right? Auditors aren't going and interrogating the client. They need to form a relationship with the client, and they're looking for errors, material misstatements. The purpose of an audit is to sample, do the best they can within a short period of time to provide reasonable assurance that the financial statements are within GAAP and are free from error. But it's not a guarantee. It is really just a situation where they're doing their best. They have tons of accounts, and if there's collusion going on, if management is actively trying to avoid disclosing something about a fraud, it's going to be really tough for auditors to uncover that fraud. So the thing that auditors try to do is have exercise due care in their audit, and that should protect them from litigation risk. And so given that guaranteeing fraud-free financial statements is out of reach, auditors are sort of reticent to take on fraud catching responsibility. And I think that disclosure, my paper shows that disclosure may spread non-public information that auditors are privy to parties that really are well incentivized to catch fraud. And I think that's going to be a really great avenue. I think that'll help prevent fraud in the future, or at least catch it once it starts, right? So I think that's really kind of all I have. I just like to again thank you to PURCE and to Kevin for setting this up, and I'm happy to hear your questions, and hopefully I can give you some good responses here. Thanks.
John, great job on the presentation. I mean, you said a few pretty shocking things, and I just want to make sure I understood them. So first of all, it sounded like you were saying that when a corporation says, look, we got a clean bill of health from the auditor, there's nothing to see here, the ratings agency or the auditor, they already came in, they checked everything out, we're fine. You're saying you don't necessarily want to believe that. Is that the idea?
Well, I don't know if I would say that so much. I would say that, it is the result of sampling, and it's the result of a process that's not going to catch every possible mistake. And so, they're not perfect. I think that's kind of the
okay.
It's the result of procedures, generally accepted auditing standards, that you're doing sampling, you're doing things to try to statistically eliminate the probability of material misstatements. But if there is a collusion going on, and management's actively working against you, it's going to be really hard.
You said, just in terms of the numbers, that if all we did was rely on the auditors and nobody else was checking anything out, 90 to 75% to 90% of fraud would go undetected. Is that correct?
Well, I'm not sure I would say that. I mean,
please,
as far as what actually does get detected, those are the numbers. But who knows if someone doesn't detect it, maybe further on auditors would detect it. But
I see. So those are kind of like, you're saying it's lower bounds in terms of catching the fraud. There could be a lot of other fraud we still don't even know is going on. And
There's that too. Yeah. So it's very difficult to do some of this research because you're excluding groups, right? There's one group where fraud that never gets caught, that will never know anything about that. The other situations are, if they're settled privately, a lot of the databases where you find fraud information are, legal data sets, and some of that is settled out of court, and you have sealed documents, and you can't really look into some of that stuff. But the ones we look at in our paper are SEC investigations, enforcement actions, where the SEC alleges fraud. So there's a specific legal allegation, right, where the management has to have an intent to deceive investors.
One of the other things that I found, kind of surprising that you said, this is before we get on to the policy aspects, but the other just sort of surprising fact is you made it sound like short sellers are the heroes here, right? These short sellers are the guys that, GameStop and all, they get vilified in the media often, and yet you see them as having this like really important role.
Yeah, well, I think in some cases you do want someone looking for bad companies, right? And in this case, they're searching out for fraudulent companies, right? And I think, it's a good role that they play. And I know it's unusual to think about short sellers as being an informative or a good group of people, a good group of actors. And I think they are for purposes of catching fraud. There's other research, right, that shows that short sellers bring a lot of information to the table in the financial markets. So.
Okay, well, we've got a whole bunch of questions about now policy, like how to move forward here. And so maybe the first one I'll ask is about your proposed mandates on disclosures. So, one policy is, I guess, what we're currently doing, which is we're requiring auditors, is it requiring them or allowing them to write short explanatory statements on certain parts of the audit? Is that kind of additional disclosure, is that the policy you'd advocate for as the best way forward here to catch more fraud?
Well, so it's a difficult situation, right? When auditors, so there's a similar problem here with auditors disclosing critical audit matters as there is with them choosing to do more about looking into fraud, right? So once auditors disclose a critical audit matter, it is a sign that they know about an area, right? And when that fraud is revealed in that area, for example, they may be more legally liable. So there's been sort of this back and forth about whether or not providing a critical audit. So it is required now. This year's, last year for firms, I think it was after 6/30/19 year ends, I think is when they started requiring auditors to provide critical audit matter disclosure. And to me, the information is going to be valuable to other people who are looking into fraud. From an auditor's standpoint, there's concern that it's all going to be boilerplate, that there's going to be the disclosures are just legal kind of disclaimers. But I don't necessarily think that. I think that it's an opportunity, at least, to identify areas that are of concern that people can look into. And I think legal liability in this area, it's based on whether or not they had due process or due care in their audit, right? So if you have due care in your audit, disclosing something about the audit should be protected from legal consequences.
So I guess what you're suggesting is that these explanatory statements, these additional disclosures, they're not going to catch everything, but requiring them helps. Like it's had this positive effect on catching some fraud. So maybe some bigger ideas. We've had some attendees suggesting bigger ideas of how how to try to close the gap between the kind of fraud the auditors find and what's out there. Sydney suggests, if auditors were independent of management, do you think more fraud would be reported? And what would it even mean for an auditor to be independent of management?
Well, so they are
I mean, I know they're
should be
external.
independent, right?
They're external, but they're hired by the management, right? Is that the
Right,
problem?
well, so this is sort of the problem before Sarbanes-Oxley, before the Enron collapse in 2000. Before then, they were hired directly by management. After SOX, though, there's an audit committee who's supposed to be independent. Audit committee is a group of people that are all part of the board of directors, usually, or related to the board of directors. And they are there to oversee the audit, right? And this audit committee is the one that hires the auditor on behalf of shareholders. So there's this whole, in the corporate form, there's the board of directors and the committees within the board of directors that are hired by investors to oversee management. And so management should be, reined in by them. But unfortunately, a lot of times that's not the case, right? Because the CEO can have influence over who's on the board of directors. And so there's this problem, right? So hypothetically, the external auditor, after Sarbanes-Oxley required there to be an audit committee that hires the auditor instead of management hiring the auditor. And that audit committee is supposed to be independent. I'm not sure if that's really the case all the time. There are some rules around who can be on the audit committee, and they're aimed at making the audit committee independent. And so, so I guess that is supposed to fix this problem about auditors being independent from the.
What if you pushed it further and had it just be that it was always a third party? If it was always, for example, the government, and the government just did a bunch of random audits, and the firm didn't have any ability to influence who they were going to see, is that a good idea? Or is that a crazy idea?
Well, I think you would get a lot of pushback from auditors about that because they've been self-regulated for so long. But yeah, there are people who have pushed this idea where the government's the one that comes in and audits companies. But it's a large industry. I'm not sure the pros and cons about that are probably outside of the scope of what I've really thought about. But you're right, it would be an alternative to doing it. In France, for example, they have two auditors come in. So you have not just one auditor, but another that come in and look at the financial statements. So there's some variation in who looks at the financial statements, but I think they're all regulated as a private company by private groups.
Okay.
But there's a PCAOB now. So sorry, one more thing. PCAOB came in to being after SOX 2. The PCAOB is supposed to regulate the auditor. So there's a government body that is kind of overseeing, reviewing the audits that companies are doing, or that audit firms are performing. So there's a lot of people involved there. Yeah.
So the French idea was having another audit firm kind of check the first audit, for like having two of them show up at once and they kind of check each other.
Exactly. But the thing here is that there's an expense. You have to figure out the balance expenses, right? This can be very costly. The solution really is to have an auditor come in and look at every account, do what's called a fraud audit. So if there's fraud going on, you do a fraud audit. You can look at every transaction, interview everybody involved, and you can find out if there's fraud or not. But if you're doing sampling, things are going to slip through the cracks potentially.
Okay, one of the attendees, Michael, has an idea that's kind of along in this direction. The idea is, rather than just bring in the auditors, what if you also were to include a behavioral expert, that came in with the audit team, and because what you emphasized was intention. Mm-hmm. And so maybe this behavioral expert could figure out if there was some fraudulent intention going on amongst the management, or something like that. What do you think about the idea of bringing in behavioral experts to kind of assist the audit team?
I think these are great ideas. Yeah, these are really good ideas. I think that they, these large audit firms try to train. So one of the things is having training to identify when someone's lying to you, or if you can pick up on cues about somebody who's potentially hiding something. And I think the audit firms have started doing some of this stuff. And one of the other things that they do is they'll run numbers through these, to see if the random numbers follow a certain sequence. There's a law, Benford's law, where numbers follow a certain sequence. And so you usually see this many ones, twos, threes, fours after at the end of each account. Something that audit firms have started doing is running all of the accounts through, or many of these accounts through Benford's law to see if something looks fishy. So there's things that companies can do. You're right. I think they will help auditors catch fraud. So yeah, I think any of this kind of training is really helpful. But again, it has to be disclosure, right? And that one part of the disincentive is if you find fraud or you find something fishy and you don't do anything about it, then it later comes out that it's fraud, you're in a tough situation, right? From a legal standpoint.
Okay, so you're saying that the disincentive for the auditor to do all these things is still there. I mean, if all they do is sort of the minimum that's required by, to make sure the company complied with GAAP, they did the sampling and they don't dig looking for more stuff, because every time they dig, it just gives them more liability later if it turns out there was something fraudulent. So you're saying maybe they're not going to run all the numbers through Benford's law because that could just expose them to liability. Is that right?
Yeah, right. Yep. Yeah. So it's hard to, even these things, auditors do want to protect their reputation, but the other thing is, if you reveal a fraud, you still hurt your reputation. Your reputation, just auditing a fraudulent company is what hurts the reputation. So, yeah.
Okay, that's troubling. So another idea suggested by an attendee is, directed at the idea of who's paying for the audits. And they said maybe it's the companies themselves shouldn't pay for the audits. I mean, that way you could bring in 2 audit firms or a behavioral expert or someone from the outside. What if it was the government or some third party that was doing all of the paying for audits? Does that help with incentives?
If the government does the audit?
Well, what if they only paid for the audit? So the corporation is not paying for the audit. The audit is being paid for by probably the government, let's say. Is that a plan that helps with incentives, or does that cause more distortions than it's worth?
Well, I think the problem, I don't know. This is something to think about, right? One of the things that the pricing of an audit, so I know independent auditors want to be able to price their audit based on the risks that they see that they're taking. By having a government entity, or the government pay for the audit, I'm not sure that this sort of market for auditors would function the same way as it does now. So I think that might be a consideration with this insurance kind of idea, but it's something to think about, right? That might be the concern, is that it's a market, and the audit firms want to price their audit based on risks that they perceive, and if there's only one payer, they might control how much you can charge for an audit.
Yeah.
So
I just like to ask kind of the big picture question here, which is, how big of a deal is this, though? I mean, are we talking about, the 100th of 1% of firms that have some fraudulent activity going on? Is this not that big of a concern, and is not worth all the effort to try to change the whole system in order to catch 1 or 2 bad apples?
Well, I think that I don't have the number of fraud. It is a large amount of fraud that goes on in the United States. But I think I can't quote the number off the top of my head, but the point I would make is if you look at these huge financial collapses, those are significant, right? Enron, it was a turning point, right? The economy went down, collapsed. So there's sort of these lack of trust in the market, which can hurt not only the company that commits fraud, but also everyone else, right? If you don't trust anything that people are disclosing, you might not want to participate in the stock market. And I think that was kind of what you saw around Enron, is people didn't trust the markets anymore. They didn't trust the information. So to me, I think the number is big of how many companies are actually engaging in fraud. But even if you didn't look at that number, you could just the externalities of a fraud are pretty big, right? It's lack of trust in the financial markets, and that's really what you want to keep.
So it's not about just the size of particular companies that committed fraud. It's about the widespread lack of trust in the system that is the result of a big fraudulent case. People not trusting the market and not trusting the system anymore.
Yep, I think that's just as important, probably more important than the actual fraud. Right.
You've got me convinced. Okay, so is this mandate of explanatory statements, is that your preferred policy response, or do you feel like there's some additional lever that the government should pull to try to crack down on fraud and find it early rather than find it late after something big has happened?
Well, so I think not only we also need this disclosure, right, to people who might be interested in catching fraud, like short sellers or the media. It's also important to have disclosure to the SEC, who's another regulator who's interested in catching fraud. So I think I think that's an accurate. I think we'll see what happens with CANs, right? See if it's actually informative disclosure or if it's just boilerplate and legal kind of disclaimers. So I think it's a good start, at least, but I think disclosure is helpful as far as catching fraud, because I think there's lots of people other than auditors who are very interested in finding these firms. So I don't know if that's a good response or not.
No, that's a great response. I mean, you're just saying, the heroes here are the short sellers, and it's the disgruntled employees, and it's those reporters out, digging for a story. That those are the people who are really going to find this, not the auditor.
I think so. Well, yeah, along with the auditor, I'd say. Yeah.
Well, maybe with the auditor's help of kind of signaling that maybe there's something here to find.
Yep. You got to get the information in the hands of the right people at the right time. I think that would be what I'd say. Yeah.
Okay. Well, that's great. John, thanks so much for this presentation. That was wonderful. We have 1 minute left. If there's any final 1 minute takeaway you want to give before we end.
I think we kind of summed it up pretty well there. Auditors kind of face these incentive problems. They do what they can to catch fraud, but given the scale of these audits, it's difficult, particularly if it's an intentional, if management's intentionally misstating their financial statements. So I think disclosure is a really effective means of distributing the burden of catching fraud to everyone out there. So that's kind of the takeaway I'd like to leave with. That's
great. Well, I just wanted to say thank you so much to Dr. Black for this great presentation. We are going to conclude the webinar in just a moment, but I wanted to thank all of you who've come to attend. I hope you enjoyed this opportunity to learn more about an important policy issue. I care a lot about government policy and how it affects all of our lives, and I always look forward to opportunities to interact with scholars who use data and try to analyze how these policies affect our lives. I invite you to help PURCE with our mission to share empirical policy relevant research findings. You can find more out about the Research Center on our website. I also invite you to consider donating to support our current research initiatives, providing special educational opportunities, and also currently providing these special information sessions down in Indianapolis for government leaders. Thank you so much for attending, and this now concludes our broadcast.